Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Crest Cooper. Today I've been joined by my colleague Mahar Afzal, who's the managing partner, and together we will take you through today's webinar. Every week we have been discussing different provisions of corporate tax law. We have discussed the basic provisions, we have discussed the cabinet, ministerial and federal decisions that have come out to explain these provisions more in detail, and then we have been discussing various tax guides. So if you missed any of our lectures, they are available at our YouTube channel. You can go there, look at them. If there are any questions pertaining to these webinars, you can always email us at info@crestcooper.com and we will be happy to reply to you. So before I recap last week's lecture, I'm going to just touch upon this FTA decision number 3 of 2024. This is a hot topic for right now because since this decision has come out, there's been a lot of queries and confusion and panic among the people. So we've made a snapshot for you of the whole decision. Let me go through it and recap it for your ease. So through this decision is effective from 1st of March 2024. FTA has broken down these different types of taxable persons. So we have the resident juridical person, we have the non-resident juridical person, and natural person. And then they further group them under those that have been incorporated before March 1st, 2024, which is before the effective date of this decision, and those that will be incorporated after this date. So let's take the example, the first category, which is the resident juridical person. So for them, they have chosen to bifurcate or to make this deadline according to the license date. So if there's any company which was formed, let's say May 2021, and a company which was formed in May 2023, both of them will have the deadline for 31st July 2024. So the year is irrelevant here. So what they have taken is just the date, the month and the date of the trade license is what is important here. So I know it seems that maybe that a company which was formed 10 years ago, maybe in May, and the company which is newly formed should have different deadlines, but this is what FTA has chosen to do. So if you have a trade license which has a month of, for say, July, then you will be looking at the deadline according to that and will ignore the year. So the other important thing here is to note that this deadline is for submitting the tax registration application, and it is not for obtaining the tax registration number at the moment. So we have plenty of time. The earliest deadline that has been given by FTA right now is 31st of May. So still 3 months away. And that is also for submitting this registration application. And we see that the furthest deadline for at least the resident juridical person is 31st December right now. So they've spread it over this year of 2024 for the resident juridical person. And if there is any resident juridical person who basically has multiple licenses, then we will be looking at the earliest issuance date, which license has the earliest issuance date, that will be followed over here. Then we have resident juridical persons who are incorporated after March 1st, 2024. So if any company is incorporated now, so there can be two types here. So either the company is incorporated here in the UAE. If that is the case, then the deadline is from 3 months from the date of incorporation. So for example, a company gets incorporated in, let's say, April. So then 3 months from that would be, if let's say 1st of April, then it would be April, May, June. So by 31st of June, they will need to 30th of June, they will need to register for this corporate tax. Then there are companies who are incorporated under foreign legislation, but they manage and controlled in the UAE. So for them, they have given 3 months from the end of the financial year. Now it would seem that they have been given a very big deadline, because if let's say their financial year is January to December, then this would mean 3 months from the end of it, which would be 31st March 2025. The reason for this is because if this is a very sensitive topic, because a lot of companies, they need to do this evaluation of what is the place of effective management for their companies which are not incorporated here in the UAE. It is not very straightforward, because this place of effective management test, which is called the POEM, that is basically very subjective. It is done on case-to-case basis, and a guideline is given. It's not an absolute test. So you need to decide if that company is managed or controlled in the UAE or not, because if it is controlled and managed in the UAE, they will fall under the resident juridical person, and then we will have to look at these deadlines. But if they are not falling under this, then they would be non-resident person, and we will need to see if they are meeting any of the conditions in the non-resident juridical category. So then moving on, the non-resident juridical person, if they are registered prior to May 1st, 2024, We have two categories: if a non-resident person has a PE, permanent establishment in the UAE, or if a non-resident person have a nexus in the UAE. So if the non-resident person is having a nexus in the UAE, the deadline would be 3 months from the effective date of this decision, which is 31st May 2024 would become the deadline. And for non-resident having P in the UAE, at the moment in the decision, it has been given as 9 months from the date of existence of PE. Now here there's a bit of more clarification is required because it seems that this is like a past date, 9 months from the date of existence of PE. The other interpretation people are taking is that that if the PE was established, let's say in May, so then we need to follow the 9 months from May, and take it as that. But that is not clear, and we would advise you that it is better right now to, by default, if this clarification doesn't come, to use the earliest deadline, which is 31st May 2024, to get your PE registered. It would be more beneficial because the penalty for late registration application right now is 10,000 dirhams, which is the same which is the late registration for VAT as well. So if there's a non-resident juridical person who are become a non-resident juridical person after March 1st, 2024, and they have a PE in UAE, then the deadline is 6 months from the date of existence of PE. If the non-resident person has a nexus in the UAE, then it's 3 months from the date of establishment of this nexus. Then moving on to the next category, which is the natural person category. So they have two categories here: the resident natural person and the non-resident natural person. For the resident natural person, if they have given this deadline that if the business activity, we know that if the threshold of the turnover is exceeding 1 million during the Gregorian calendar, which is January to December in 2024, then only they will need to see that if they have to register or not. So they have given this 3 months deadline. So after the 2024 year has passed or any year has passed where you are crossing this deadline, then it has to be 31st March of the subsequent calendar year. So if 2024 somebody is meeting this threshold, then they need to register by 31st March 2025. If they're meeting the threshold in 2025, they will need to register by 31st March 2026. Then the non-resident natural person, for them, they have not given the same deadline. They have said that, whenever they are meeting this requirement of exceeding this 1 million, then they need to register from 3 months from that. So here also a little bit more clarification is needed because from the little words of it, it seems that if, a non-resident natural person is exceeding this turnover 1 million threshold in, let's say, June of 2024, then they need to register within 3 months and not wait for the whole year to lapse like for resident natural person. So we will keep you updated with any new clarity that comes in for this, but there's no need to panic. There's plenty of time for the clarification. Like I said, earliest deadline is 31st of May, so we have plenty of time. Now moving on, I will recap the last lecture. So we have been discussing, I think from the last 6 weeks now, this tax group guide which had come out. We have discussed it in great detail. We have finally finished this guide and we are moving on to a new topic today. But I will recap this guide for you. So this tax group guide basically tells you that if there are two or more taxable persons who are meeting the conditions which are given in under Article 40 of the Corporate Tax Law, so then they can be treated as a single taxable person. They can form a tax group. Now here I would like to mention that a tax group for corporate tax purpose is different for a VAT purpose. So we get this question a lot where people get confused that if we already have a VAT group, then can we form a corporate tax group and the same companies need to be there? No. You have to look at both the regulations separately. The conditions to meet for a corporate tax group and for a VAT group are different. You have to see the condition given under each law. And then it's not necessarily that if you have a VAT group of 4 entities, the same would be meeting the condition for corporate tax or vice versa. So you have to look at them independently. Now we have discussed there are some benefits of forming this tax group. So one return will need to be filed. The income and losses of the members can be offset. Any transfer of liabilities or transaction done between the tax group member, they can get disregarded, eliminated. So these are some of those conditions. So now we will be discussing the conditions to form a tax group. So what are those conditions which are being mentioned in Article 40? So the important thing to note here is that these conditions, they need to be met. All of them need to be met. So if one condition is not being met, you cannot be part of a tax group. And these conditions need to be consistently met throughout the whole of the tax period. Then only you are eligible to form a tax group for that tax period. And what are these conditions? So the first condition is juridical person condition. This condition says that the parent company and each subsidiary that is wanting to form this tax group need to be juridical person, means they need to be legal persons. The legal identity should be separate from the owner. So, they can't be a natural person. They have to be a company like a private company, public joint stock company, LLC company. Then the second condition is the resident person condition. Here, the parent and each subsidiary, they need to be resident person, like we discussed in the FTA decision 3, that resident person, they can be either they are incorporated under the laws of the UAE, or they are incorporated under the laws of a foreign jurisdiction, but they are managed and controlled in the UAE, or they are resident of UAE under any double taxation treaty. So if that is the case, then they will be resident person. They will be meeting this resident person condition. Then the next is the share capital ownership condition. This says that the parent company needs to own at least 95% of the share capital of each subsidiary that needs to be part of this tax group, either directly or indirectly through one or more of their own subsidiaries. So here, what I will say is that, this is a legal ownership of the share capital. So if there's any side agreements, which is giving right to that share capital, but not the legal ownership, then that won't be, those need to be disregarded, and only the legal ownership will be looked at. Then there is the voting rights condition. Here, the parent company needs to at least have 95% in the voting right of each of the subsidiary, either directly or indirectly. So it could be the case that, the share capital condition is being met, but the voting right condition is not being met, because sometimes the share capital shares are issued without any, voting rights. So in that case, we need to see that both these conditions are being met. Then we have the profit and net asset condition. Here, the parent company needs to be entitled to at least 95% of the subsidiaries' profits and net asset in the case of liquidation. Again, can be done directly or indirectly through one or more of their subsidiaries. Then the next condition is the exempt person condition. So the parent company or any of the subsidiaries that want to be part of the tax group, they cannot be an exempt person who are treated as exempt under the law. They cannot be a qualifying free zone person. That is the next condition. So if there is a free zone person who is not meeting the condition to be a qualifying free zone person, or is opting out from being a qualifying free zone person, then they can be part of a tax group. Otherwise, they cannot be part of a tax group. Then there's a financial aid condition which says that all the companies need to have the same financial aid. So if the financial aid is not matched, then they need to change this financial aid before they can be part of the tax group. Then the accounting standard condition says that the parent and subsidiary needs to be following the same accounting standards. So, if one company is following IFRS and the other company is following IFRS for SME, that cannot happen. They both have to follow the same accounting standard. Then we discussed that, we just talked about the share capital ownership condition, the voting right condition, the profit and net asset condition says you can either directly or indirectly hold the ownership. So what do you mean by this indirect ownership? So we looked at some examples. So in example 1 and 2, in both these examples, company A is having a direct ownership of 90% of company B. In the first example, company A is having 80% of the ownership of company C. In the second, company is having 95% ownership in company C, and then company C is having a 10% ownership of company B in both these examples. So if you look at the example 1, the effective ownership of company A in company B is 90% directly, and then is 8% indirectly, so 98%. And then in example 2, it's 90% directly, and then 9.5% indirectly. So it would seem that in both these cases, this effective shareholding is being met. But in example 1, this condition of indirect ownership is not being met, because it says that the company can hold this indirectly through one or more of its subsidiaries. So in the first case, in the first example, company C is not a subsidiary of company A, because company A only has 80% of the shareholding in company C, so it doesn't qualify as a subsidiary. In the second example, because company A has 95% of the ownership, so it is meeting the subsidiary condition, and then only we will look at the second, that is it more than 95 or not. So only in example 2, this condition is being met. Then we looked at small business relief. We discussed that this will be looked at the group level. Consolidated revenue of the group will be looked at. So in our example, company ABC had individual, revenues which were less than 3 million, which is the benchmark for the small business relief threshold. So we will not look at look at this individually. We will combine it, and we will see that if it is meeting this threshold or not. So in our example, it is going above the threshold and it is becoming 3.5 million. So we will not be eligible for the small business relief. And then we had discussed that there is no limit of number of people then can be part of a tax group, and one person can only be part of one tax group. So they cannot at the same time be part of different tax groups, because this tax group is now treated as a single person, so it is not possible for one company to be part of different tax group. So let's look at example A. So we had seen that here company A has a 95% ownership with company B, so it can form a tax group. Then it has indirect ownership in company C through company B, and company B has a direct ownership of 95% in company C. So this in turn is not giving the effective ownership of more than 95. This is giving 90.25. So company A cannot be part of a tax group, cannot be in a tax group with company C. It can only be part of a tax group with company B. Company B, on the other hand, can be part of a tax group with company A or of company C. So they need to decide that which tax group they want to form. So they have two possible tax groups in this example. In the second example, the company A is having direct ownership of company C 50%, and it has direct ownership in company B of 95%, and indirectly it is having ownership in company C as well through company B, who has the ownership of 50% in company C. So here the direct ownership is 50%, indirect ownership will become 47.5%. So this brings it to 97.5%, and in this case, they can be part of the same tax group. Then we discussed that if the conditions of Article 40, which we just discussed, they are being met. So now a tax group can be formed. Okay, so now only just because the conditions are being met, it is not compulsory to form a tax group, but if there is any advantage for the group, so they can go for this tax grouping. Here, the parent company assumes the responsibility for the compliance of the whole group. And so any applications for new subsidies, that's the responsibility of the parent company to prepare the consolidated financial statement, to file the tax return on behalf of the whole group, to settle the corporate tax payable within time, to apply for any tax return, or manage the registration, deregistration of the group. This will be under the responsibilities of the parent company. To also maintain the proper supporting documents, or to do any correspondence with FTA. Then we discussed the life cycle of a tax group. We said that if any new application has to be submitted to the tax group for, let's say, a new subsidies joining, so FTA, so then the parent company will need to do this with the subsidy. If a group member fails to meet any condition, so this is a mandatory condition, that company has to leave the tax group if they are not meeting the conditions which we discussed in Article 40, and they need to do it within 20 days. If there's a change of the parent, then not necessarily we need to deregister group, because if they're meeting the same conditions of the parent or a legal successor of the parent, then they can still, the tax group can remain with the replacement of the new parent company. We discussed that if the group member ceases to exist, so this needs to be looked at a group level. So if one member is not doing business, they need to leave the group. The group will not be deregistered. But if all the members have stopped meeting the conditions or are not doing business anymore, then this tax group will need to be deregistered. Then we discussed the elimination of intergroup transactions. So we had discussed that one of the duties of the parent company is to consolidate this financial result for all the group entities. So here the intergroup transactions, they get eliminated. So these are the transactions which are between the parent company and the subsidiary, and also between various subsidiaries in the group. So let's, for example, parent company is company A, and then there are subsidiaries B, C, D. So any transaction between A and B, A and C, A and D, or between B and C and C and D, they all will be eliminated, and they will be excluded. The one condition is that these transaction needs to take place during the same period where all these members were part of the tax group. Then that can happen. So for instance, we looked at the example, if company has paid 100,000 of interest to company B in a tax period, and company A and B have formed the tax group which is effective from beginning of that tax period, so they were part of the tax group during that period, then all this interest paid will be eliminated, since both the parties are part of the tax group. This requirement to eliminate the intergroup will also apply to valuation adjustment provision, changes in the accounting value of asset and liability, which result as a gain or loss. Also that one company will have an income and a corresponding company will have an expense when this intergroup transactions are being eliminated. So that is important. We discussed that there is an exception to this elimination, like we were discussing that these intergroup transactions will be eliminated. We discussed that there's one exception to it, that is where a member has recognized the deductible loss in a tax period prior to joining or forming this tax group, then this transaction is not eliminated, and the income is included in the taxable income of the group up to the amount that was previously deducted prior to joining or forming of this tax group. So this is when the member was not part of the tax group and this deductible loss occurred. Then we had discussed this application of corporate tax provision. Companies treated all the entities are now considered as one, and they are treated as a single entity. So we will look at some of these provisions of the law as a whole according to the tax group and not individual entities. So, for example, corporate tax rate. So we know that 0% is applicable on taxable profit up to 375,000. So this will be looked at a group level and not entity level. So we are not going to look at all the taxable profits of the different entities of the tax group and give them this benefit of 0% up to 375. No, all the taxable profit, which is of the group level will be seen and only 0% on the group level will be applied. We already discussed the small business relief will also be looked at. The consolidated revenue will be looked at and not individually. Then for the purpose of ownership requirement, when we are looking at the qualifying group relief or the transfer of tax losses and the direct and indirect ownership is being looked at, this will be looked at from the group level as well. So the parent and all the ownership of the aggregation of the ownership interest of all the subsidiaries, that will be looked at. So this is one of like the advantages of the tax group. The same for participation exemption when we're looking at determining the ownership interest of 5% or assessing the acquisition cost of 4 million, we will look at this from the tax group level, not the individual companies level. Then we discussed about elections. So there are certain elections need to be made, when you under the corporate tax law. So what will happen in that case? So we discussed that, for the qualifying group, for the transfers within the qualifying group, the taxable person has an option to exclude the gain or losses. So this election needs to be made when the transfer takes place. This election cannot be revoked. So what happens if it's a tax group? So now if there is a tax group and none of the members have made any election yet and the tax group is choosing to make this election, then it will apply to all the members. It will keep applying to all the members, even if any member leaves the tax group or even if the tax group ceases to exist. And if a taxable person has not made an election yet, and if they're forming a tax group and any of the entities in that tax group have already made this election, it will apply to the whole tax group. And similarly, if there is a tax group which has not made this election and a new subsidiary joins which has already made this election, then it will apply to all the companies. Then we had discussed that when we're looking at the carry forward of tax losses and we're looking at the continuity of ownership condition, this will be looked at in terms of the parent company only. So the ownership interest of the parent company only will be looked at, but for the continuity of business condition, we will be looking at the tax group as a whole. Then we looked at that if the tax group is following the cash basis of accounting, we need to look at the revenues up to 3 million at a group level. For the accrual basis, we will look at the group level if it is more than 3 million or not. So if there is the tax group is following the accrual basis of accounting, let's say, and they have the option to account for gain and loss on this realization basis, and then the company group entity decides to leave the tax group. So it is required to prepare the financial statement on the same accounting basis as was applied when it was part of the tax group. Similarly, when we are looking at the expenditures, they should be wholly and exclusively for the purpose of the business. So we will be looking at the tax group again as a whole when we are looking at this and not at individual companies level. For the transitional rules, that is, we can limit the taxable gain, to the gain that arises after the first tax period, and disregard the gain which is from the first tax period. So what is being applied here, which method is being used? So we need to look at it as a whole tax group level. And whatever rules that will be applied or elections which will be made under the transitional rule, this will apply to all the members and it will keep applying to them even after they leave the tax group or even if the tax group is disbanded. Then we discussed that there are certain cases where we will not be looking at the tax group as a whole. We will be looking at the individual entities. There are certain cases given in the guide. So one of the cases is when there is unutilized pre-grouping tax losses. So we know that if the subsidiary, before it joined the tax group, it has tax losses available with it. So that will be looked at separately. It can only be utilized against the taxable income of the member of the subsidiary and not for the whole group. So here there are two conditions. First, that the member should have adequate taxable income. If they don't have adequate taxable income, then it cannot offset with the losses that it has from the pre-grouping. Also, that we need to club it, or there's a threshold of 75% of the group's taxable income. So whatever this limit comes out to, we cannot offset more than this amount. So there are two ceilings, you can say. One is the 75% of the group taxable income, and then it cannot exceed the members' taxable income as well, the one who has this pre-grouping tax loss. Then we discuss if this foreign tax credit that has been earned by one of the members of the tax group, then that also cannot exceed the corporate tax due on the member's relevant income. So we will look at the member, the subsidiary who has this foreign tax credit and not the tax group as a whole. If there are any benefits given under Article 22G to any of the subsidiaries, then it will be, or any of the companies of the tax group, then we will look at the individual company, not the whole tax group. Then we discussed that the fourth case is unutilized carry forward pre-grouping net interest expense. So this, we know that we can adjust up to 30% of the EBITDA or 12 million, whichever is higher. So when we are looking at this 30%, it will be looked at the group level. So here also the two conditions, one is this ceiling and the other is that the member who has this pre-grouping net interest expenditure should have sufficient taxable income. So in these four cases, we will look at the individual companies. We will not look at the tax group as a whole. Then we had discussed what is the order of utilization of losses. So what are the different kind of losses? So we have pre-grouping losses. So we just discussed that pre-grouping losses are the losses which the subsidiary brings into the group, and it had that before it was part of the tax group. So then we have the group losses. The group losses are of two kinds. One is the restricted group losses. So this here implies that if a tax group existed and there are certain losses that happened, and then a new member joined the tax group, so that member was not there when the other losses happened. So those losses now get classified as a restricted group loss. So for example, company A and B and C are part of the tax group. There is a tax loss there of 10,000 dirham, let's suppose. Then after 2 years, company D is coming in. So this tax loss that is existing before in the tax group, that only pertains to A, B, and C and not to the D. So that is why it's a restricted group loss. And then we will look at, by default, the other tax losses of the group where A, B, C, D are all part of the tax group will be non-restricted group losses because they belong to the whole group. And then we have transferred losses if one company has transferred it to the other, or losses that you come across with because of due to business restructuring relief. So these losses, the order of utilization would be first the pre-grouping losses will be utilized against the income of the subsidiary. And we already saw that there's a ceiling there. There can't be more than 75% of the whole group taxable income, and it cannot be more than what the subsidy has, the subsidy's income for that year. Then we will look at and utilize the group losses. The first we will utilize the restricted group losses. So in our example, the ABC, when it was part of the tax group, the losses were incurred there. That would be utilized first. And here we need to see the income of ABC if that is there. And then we will be looking at the non-restricted group losses. And after that, with the transferred losses and then the business restructuring losses. So this is the order of utilization. Then in our previous lecture, we had discussed the net interest expense. So net interest expense is the interest income minus the interest expense. So whatever remaining net interest expenditure is there. So for net interest expenditure, like for tax group losses that we had discussed, that there's restricted tax group losses, there's no concept of restricted tax group net interest expense. And you cannot transfer your net interest expense to another like you can do for tax losses. Business restructuring relief is also not extended to these unutilized net interest expense. The net interest expense can be offset in the sequence of their occurrence. And the net interest expense will also stay with the tax group, even if the subsidy is leaving the tax group. Only the unutilized pre-grouping net interest expense is what the subsidy can take away. And if the tax group is dissolved, then this unutilized net interest expenditure will be carried forward by the parent company. So if you have missed any, if you want more detail on all of these, topics that I just discussed, they're available on our YouTube channel, like I said. And now Mahar will take you to today's webinar, which is on deferred tax. So Mahar, over to you.
Hello, everyone. Thank you very much, Faiza. I believe everyone will be clear regarding the corporate tax registration as well as tax group. So we are discussing deferred tax today. So what is deferred tax? As the name itself implies, deferred tax means the tax which has been deferred. This is called deferred tax. The tax that has been deferred, this is called deferred tax. Now we'll discuss why deferred tax arises. What are the reasons for this? How can we adjust it? In which situation it arises, in which situation it doesn't arises. So we'll be looking deferred tax as this is a requirement of international AES 12 as well, and this is a requirement of the UAE Corporate Tax law. So what is deferred tax? As I mentioned earlier, what is deferred tax means? The tax that has been deferred and it will be settled at some future date. This is called deferred tax. So what is the reason for this? The reason for this, accounting profits bases are different, tax profits bases are different. Accounting profits provisions are different, like provisions for the IFRS, the calculate the provision that applicable to calculate the profit as per IFRS. These provisions are different. Provisions for tax authorities are different. When there is a different principle to prepare the corporate tax, to prepare the financial statement, or to prepare to calculate the taxable income, different provisions, different principle will lead to ultimately different taxable income or different accounting profit. So this is the reason that these differences, as I mentioned, different principle, different provisions, accounting profits are different from the taxable profits. Once the accounting profits are different from the taxable profit, these differences can be of two nature. It can be a permanent nature, it can be of temporary nature. So the permanent nature differences like fines and penalties. This is a financial statement. This is as per IFRS. This is as per tax purposes. Here, fines and penalties, it will be allowed to calculate the taxable. It will be allowed to calculate the tax, so accounting profit. Fines and penalties will be allowed to calculate the accounting profit. It will reduce the tax base. But fines and penalty, it will not be allowed to calculate the taxable income by the tax authorities. So this is called a permanent difference. The one expense, it has been accepted by the accounting IFRS, but this expense has not been accepted by the tax authorities. So it will lead to permanent differences. Permanent differences. There can be second can be a temporary difference. A temporary difference means these differences will have an impact in multiple tax period. Means expenses, assuming it has been accepted by both of the authorities, both of the principal, IFRS and tax authority, but timing differences are there. Over the period of time, on the long-term basis, it will have same impact, but difference, some impact will be in this period, remaining will impact in the next tax period. So this is the card. So as I mentioned, differences can be permanent, differences can be temporary. If these are the permanent differences, it will impact in one tax period. It will not be have any impact in the future tax period. And the example, as I mentioned earlier, fines and penalties. For example, the fines and penalty, dividend, capital gain. This specifically dividend and capital gain, as I mentioned. These dividend and capital gain, we are not discussing. Just keep in mind, we are not discussing the deferred tax, keeping in view the provisions of the UAE corporate tax law. We are generally discussing deferred tax. In our next webinar, definitely we'll be discussing the applications and the provisions related to the deferred tax related to the UAE corporate tax law. So usually dividend is income, but dividend is not subject to tax. Capital gain is income, capital gains is not subject to tax. Fines and penalties are the expenses for accounting purposes, but these fines and penalties are not the expense for tax purposes. So if dividend is the income for accounting purposes, capital gain is the income for accounting purposes, in the same way, fines and penalty is the expense for accounting purposes, but these all three items are not accepted by tax authorities. As an income, you can say, or an expense. Once the differences will be there, these are permanent in nature. It will not have any impact in the future tax period. It will impact in one tax period. So these are the permanent differences. In the same way, temporary differences are there as well, like the pattern of allocation for the depreciation. In some jurisdiction, the pattern of allocation for the depreciation, pattern of allocation of the assets, tax authority is just assuming the tax authorities are asking this asset needs to be depreciated over the period of 5 years. In the same way, accounting principles said that you can depreciate the asset over the period of 10 years, means over the period of 10 years, tax depreciation and accounting depreciation, it will be same. But initially in the 5 years, taxable depreciation will be higher, accounting depreciation will be lower, means accounting profit will be higher, taxable profit will be lower. In the same way, where you are claiming higher accounting tax depreciation, it will lead to your lower taxable profit. You will be paying lower tax now, future you will be paying more tax in the future. So these are the temporary differences which have impact in more than one tax period. Overall impact will be same over the period of time, but the timing differences are there. So these temporary differences are two types. These temporary differences are taxable temporary differences or deductible temporary differences. So taxable temporary differences, deductible temporary differences. Taxable temporary differences lead to deferred tax liability. Deductible temporary differences lead to deferred tax asset. So how it lead to deferred tax liability and deferred tax asset means where you are paying lesser tax now and you will be paying more tax in the future. So you need to book the liability today. This is called taxable temporary differences. You need to book deferred tax liability today. In the deferred tax liability, your current tax period, taxable income or taxable profits are lower. You are paying lower tax now, but in the future, you will be liable to pay more tax. So this is called taxable temporary difference. It lead to deferred tax liability. In the same way, deductible temporary differences are there as well. And where that deductible temporary differences arise, you are paying more tax now, you will be liable to pay lesser tax in the future. Once you are paying more tax now, you will be booking as an asset, and the same you will be adjusting in your future liability. So these are called deductible temporary differences. So temporary differences, if I'm asking typically with the point of view of IAS 12, the law, basically IFRS say this is a difference in between the carrying amount and the tax base. Carrying amount, you can say in the language of layman, you can say the carrying amount is the amount that has been assigned as per the IFRS. Usually this is costless accumulated depreciation, amortization, whatever is the case, this is a carrying amount. Do you can say on principle, on overall basis, or you can say on in the language of a layman, carrying amount is the amount that has been assigned to any item by the as per the principles of IFRS. Tax base means the amount that is assigned as per the tax principle. The difference between these, as I mentioned earlier, it can be permanent differences, it can be temporary differences. If these are temporary differences, as I mentioned earlier, it can be two types, and it lead to deferred tax excess or deferred tax liability. Deferred tax liability will be there where there will be taxable temporary differences. Deferred tax asset will be there when there will be deductible temporary differences. Taxable temporary differences will be where you will be paying lesser tax now. Your current period taxable profit will be lower. In the future, you will be liable to pay more tax. And deferred tax asset will be there. Your current period taxable profit will be here. You will be liable to pay lesser tax in the future. The deferred tax asset. So this common examples for the temporary differences, I mean, deferred tax revenue, deferred revenue. If the revenue is being deferred, assuming you are receiving an amount, and tax authority says, assuming you are receiving 200,000 today, and you are not given the services, or you are giving the services over the period of time. So tax authorities might be will ask you, usually tax authorities are following cash basis of accounting. Might be the tax authority will ask you, you need to book this 200,000 as an income, but you will amortize this revenue over the period of time. Means in the first year, your taxable profit will be here because you have booked 200,000 as an income. So your current period taxable profit will be here, but once this will be amortized over the period of multiple years as accounting principle in the future, your taxable profits will be lower. In the current period, your taxable profit will be here. In the same way, the expenses such as bad debts provision, warranty, they lead to deductible temporary differences as well. For the bad debts provision, as I mentioned, usually tax authorities follows cash basis, or when the debts will be actually written off. Provisions usually is not being accepted by the tax authority. Whenever you are creating the provision, your accounting profits will come down, but this provision will not be accepted by the tax authorities. Your taxable profit will be higher, accounting profit will be higher. Whenever the taxable profits are higher now, and it will lead to deferred tax asset. In the future, you will be liable to pay lesser tax because you will adjust this current period deferred tax assets in the future. So deferred tax liability we have discussed, deferred tax assets we have discussed, taxable temporary difference we have discussed, deductible temporary difference we have discussed. In the same way, prepayments, whenever you are making prepayments, if the tax authorities are following cash basis of accounting, they will allow you the prepayments as an expense, but you will amortize those prepayment over the period of time. So once you are prepayment, you are being allowed as an expense. It means higher expense in the current tax period, lower tax. This will lead to the this is due to the reason of temporal differences as well. So if I'm making the summary, this is a very important slide. It will give me the overall view. So accounting profits are different from the taxable profits. We have discussed what is the reason for this. These reasons can be permanent differences, or these reasons can be temporary differences. In the permanent differences, we have discussed fines and penalties. In the permanent differences, we discuss dividend income. In the permanent differences, we discuss the capital gain. These are the various examples where your accounting profit will be different from the taxable profits. So if accounting profit is different from the taxable profit based upon the permanent differences, these permanent differences will not arise any deferred tax liability or deferred tax assets. So it will be stopped. It will be impact in one tax period. It will not have any impact in the multiple tax period. Now the temporary differences are there. The temporary differences, as I mentioned, these are on temp basis. Over the period, it will have overall same impact. It will impact on the multiple tax period. So incurred in one tax period and would be offset in the future tax period or period. It's called deductible temporary differences. It can be taxable temporary differences. So deductible temporary differences can be where your taxable profits are higher due to the accounting as compared to your accounting profit. It lead to deductible temporary differences lead to higher taxable profit in the current tax period, as we discussed, and lower taxable profits in the future. So where you are higher taxable profit in the current tax period, it will lead to deferred tax asset that will be adjusted in the future. I will discuss the example. Bad debt provisions are there, warranties are there. These are the few examples or deferred revenues. These are the few examples that lead to deductible temporary differences. At the end, it will lead to deferred tax asset. In the taxable temporary differences, they are taxable temporary differences in your current period. Taxable profits will be lower as compared to your current period accounting profits. If your current period taxable profit is lower as compared to your accounting profit in the current tax period, means in the current tax period you will be paying the lower tax. In the future you will be liable to pay more tax. You know this, that you will be liable to pay more tax in the future. So this is the reason that you are booking deferred tax liability today. So just look into these examples as we discuss. Just look into this example. In this example, I have shown as permanent differences. I have shown as fines and penalties. Fines and penalties. Rest everything is same. Tax period is same. Sorry, this IFRS income is same. COGS is same. So fines are there. Fines, it has been claimed as per IFRS, and it has reduced the accounting profit 1.50,000. So my accounting profit 1.2 million, my taxable profit 1.250. So we know exempt, there's no tax up to 375,000. Any income beyond this 825,000, and 9%. If I'm taking up this is the amount. If I'm 9% taking up this is the amount. If you see the overall impact and difference is 4500. This 4500 is the basically difference as per the IFRS, as per the tax authorities. So IFRS, this is expense. As per tax authorities, this is zero. This is my differences, but these are permanent differences. It will not have any impact in the future tax period. So we are not liable to book any liability. We are not liable to book any asset related to this. My mere simple transaction will be tax expense will be debit, tax payable will be credited. I know what is my tax payable. Tax payable is 78750. It will be my tax payable, and related expense I need to book tax expense. Current period tax expense will be 78750. Important thing is, in this example, we have not booked any deferred tax asset. We have not booked any deferred tax liability. The reason is this is a permanent difference, and it will have an impact in the current tax period only. It will not have an impact in the future tax period. Just look into this. These are the temporal differences. These are the taxable temporal differences. We have already discussed taxable temporal differences means your current period taxable profit will be lower as compared to your future taxable profits. So your current period taxable profits will be lower. I have taken this example, depreciation. Assuming there is one asset. The value of the asset is 200,000. Now, this is an assumption that the tax authorities are depreciating the asset in 1 year. accounting principle, we can depreciate the asset in 2 years. This is basically principle. In the beginning, in the very beginning, we'll discuss principle will be different, provisions will be different. It will lead to different taxable profits and difference in between taxable profits and accounting profits. So this asset has been depreciated by tax authorities 100%, 200,000 in the first year. But accounting principle, they said 50% in the first year, 50% in the second year. So once this accounting depreciation is 200,000, 200,000 has been depreciated, higher depreciation in the current tax period as per the tax laws, lower depreciation as per the IFRS. Since higher depreciation, it means current period, my taxable profit will be lower by 100,000. So these, since this current, once this current period taxable profit will be lower as compared to the current period accounting profit, so it will lead to deferred tax liability. So here you can see this is my profit as per IFR. This is my profit taxable income. This is taxable profits up to 375,000. There is no tax. Remaining amount, this is the remaining amount which is subject to tax. If I'm taking 9% of this, 9% of this amount, the difference in between is 9,000. This 9,000 is my deferred tax and deferred tax liability. And this arises because I have claimed more depreciation in the current tax period as per the tax principles, and as per the accounting principle, I have claimed lesser depreciation. So what will be the entry regarding this? This is the carrying amount, the value assigned by tax authority. This is the tax base, the value assigned by tax authority. This is the difference. This is the temporary difference. So if I'm taking 9% of this, sorry, this is not temporary difference. This is 9% of temporary difference, which is my deferred tax liability. If I'm taking entry, my entry will be deferred tax expense. Okay, what will be the entry? I need to pay to the tax authorities 60750. It will be tax payable. So this 9,000 is my deferred tax liability. My tax expense will be some of this. Basically, these are two entries. One entry is here, tax expense debit, tax payable. Here the second entry, tax expense debit, deferred tax liability credit. So this is the first year. Now second year. In the second year, you can see now tax depreciation is 0. Accounting depreciation is 100,000 because accounting authority as per IFRS 100,000 we have claimed in the first year, 100,000 we are claiming now. But total 200,000 has already been claimed by the tax authorities as the principle applied by tax authorities. So here in this profit, my accounting profit will be lower, my taxable profit will be here. So if I'm taking 9% of this, 9% of this, this is again, this is the taxable temporary difference, 9,000. What will be my entry? My tax expense will be 69750. This is the amount that I need to pay, 9% of my taxable profit. This is the 9,000 that deferred tax liability that I have already created here. It will be reversed here. Remaining, it will be my tax expense. So if you can see in the first year and second year, in both of the years, my total depreciation is 200,000, 200,000. But timing difference is there. In the first year, tax depreciation is 200,000, accounting depreciation is 100,000. In the same way, in the second year, tax depreciation is 0, accounting depreciation is 100,000. So at the end, what would have happened? This has generated temporary timing differences. It has led to deferred tax liability. Now looking at deductible temporary differences, deferred income. A company has received 150,000 in the first year. Tax authorities are usually following cash basis of accounting. They said, okay, you have received 150,000, you need to book as your taxable income. But they are asking, they have not even given the services, how can they book the income? But they said you have received the payment, you are liable to pay the tax. They are following usually cash basis of accounting. I'm not talking about specifically regarding the UAE corporate tax principle as we beginning in the as I discussed in the very beginning. We are discussing general principles of deferred tax. So 150,000 has increased the taxable income of the company, and the company is paying higher tax in the current tax period. The company will be liable to pay lower tax in the future. So based upon this 9229, this is 9% of my remaining basically taxable income. So what is my tax payable to authorities? 92250. This is my carrying amount. Accounting 0, tax base is 150,000. Difference, basically this difference is 9% of the deductible temporary difference. It has led to my deferred tax asset because I need to adjust this in the future. So what will be my tax expense? 78,750. In the second year, now this 150,000, it has already been booked, claimed by tax authorities. Basically, we have already paid the tax on 150,000 in the first year. We will not be liable to pay tax on this 150,000 in the second year. But in the second year, the company has provided the services or whatever that delivered the goods. Deferred income has been converted into actual income as per the IFRS principle. In the second year, the accounting profit will be higher as compared to their taxable profits. So once the accounting profit will be higher, taxable profit will be lower, they will be liable to pay lesser tax as compared to the accounting profit. So the tax is 78,250. So this is the tax payable 78,250. What is the deferred tax asset? They have already debited. It will be credited 13500. What will be my tax expense? 92250. So this is over from my side. Thank you very much. So our topic of discussion today was deferred tax, and we discussed where this deferred tax arises. These are basically arises due to taxable temporary differences. Where there are temporary difference in between the accounting profit and tax profit, temporary difference will lead to deductible or taxable temporary differences. It will lead to deferred tax asset or deferred tax liability. Permanent differences will not lead to any deferred tax asset and deferred tax liability. Permanent differences will have impact in one tax period, and temporary differences will have impact in multiple tax period. Now IAS 12. IAS 12 says from the effective date of the law, you are liable to book the deferred tax liability or deferred tax assets if the taxable temporary differences are there. Now in the UAE, corporate tax law has been implemented starting from 1st of June 2023. Now, if the companies are closing their financial statement or closing their books after 1st of Jan 2023 and taxable temporary differences are there or deductible temporary differences are there, they need to book the deferred tax asset or deferred tax liability that we will be covering in our next webinar. That what are those items that are leading to deferred tax asset, or what are those items that are leading to deferred tax liability, how the industry doing the current practice, how they are treating it in their books. But I have told you the provisions of IAS 12. I think this is almost the same thing, that the company need to record the deferred taxes in their financial statement after the effective date of 1st of June 2023. Why that IAS 12 says after the effective date of the law, it doesn't matter your financial period starting from 1st of Jan 2024, but the tax is in place. And tax was in place starting from 1st of June 2023. If you are closing your financial statement for 2023, even your tax period is starting from 1st of Jan, it means for the 6 months you are might be there is a taxable temporary difference during this 6 months, might be deductible temporary difference during this time. You are liable to book the deferred tax asset or the deferred tax liability, whatever is the case, and that we will be covering in our next webinars. Thank you very much. Thank you. This is over from my side. If you have any question, you can ask me. You can ask my team. Faiza is there, Shahid is there, Anwar is there, and the rest of the team members are there as well. We are always there. You can give us a call. You can drop us an email at info@crestcooper.com. And if you are in need of any support regarding the corporate tax registration, impact assessment, implementation, transfer pricing, calculation of the deferred tax asset or deferred tax liability, whatever is the case, we are always there to support you. Thank you very much. Thank you. If you have any question, you are most welcome. So what about the rental received in advance? We will be discussing this in our next webinar. As I discussed, rental retrieved in advance is from asking generally whenever you are receiving the money, generally, I'm not asking specifically regarding the UAE corporate tax, whenever you are receiving the rental in advance. So usually tax authorities follow cash basis of accounting. Usually tax authority follow cash basis of accounting, and they will ask you to pay the tax in the current tax period. But this rental will be amortized over the period of time as per the IFRS principle. But if the tax authorities are following the cash basis of accounting, you have received the rental, your current period taxable income will be higher as compared to your future taxable income, or you will be liable to pay more tax in the current tax period. It will lead to deferred tax asset, and that will be adjusted over the period of time. Any other question? You are most welcome. Someone has asked, just wanted to know if that webinar for the tax group or deferred tax. I think we have covered, I think Faiza, she has already replied. We have covered both of the scenarios already. If you have any more questions, you are most welcome. We have just discussed deferred tax in the language of a layman. We have not discussed specifically provision related to the IFRS, carrying amount, tax base. We'll discuss sometime else, but generally, deferred tax, the tax that will be deferred over the period of time, it all depends upon the different accounting principle, different tax principles. Depreciation, existing assets, how to adjust in the tax. Depreciation, again, I said, but it all depends upon the pattern of allocation. What is the pattern of allocation? But in the UAE law, accounting depreciation is equal to the tax depreciation. And for the time being, might be they will bring some sort of clarification, some sort of amendment in the future. For the time being, you can claim whatever accounting depreciation you can claim for tax purposes as well. Is real estate industry is affected with the deferred tax? We will all, specifically for the UAE guys, specifically for the UAE, we'll be discussing in our next webinars. So I didn't want to go into the detail. We will definitely a lot of questions regarding the UAE. We'll be discussing in our coming webinar. It was a general discussion. What is deferred tax? Everybody was asking the question, what is deferred tax? How this is arising? What is the reason for this? So I've decided to cover in this webinar. What is the clause of IAS 12? Some clauses are there at the end of the IAS 12. You can see they are asking if the tax is effective, the business need to book the deferred tax asset or deferred tax liability, whatever is the case, in which it says about recognition of the tax for tax. You can go through the IAS 12. I think at the very end, you will find some clauses regarding this. For example, tax expenses is 10,000, tax payable is 8,000. Will there be 2,000 go? Tax expense is 10,000, tax payable is 8,000. Tax payable is all together depends upon the taxable income. Tax expense is straightforward separate thing. Tax expense will be adjusted to calculate the taxable profit. Nothing to do with the basically tax expense and tax payable. Okay, is there any permanent difference? It's permanent difference. Permanent difference, I think I have already given you an example what the reason of the permanent differences. So in the next webinar, will you be covering the complication arising from the lease accounting IAS 16 universal tax provision, which I believe do not recognize IFRS 16. We'll see what provisions we are covering in our next webinar. We will cover deferred tax, keeping in with the provisions and principles of UAE corporate tax law. Well presented, easy to understand example. Thank you very much, guys. I really appreciate your time. Thank you very much and have a lovely evening. Stay connected. Take care. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.